My greatest pleasure to welcome you to MTN Group's interim results presentation for the period ending 30th of June 2017. In particular, would like to welcome you members of the investor community who are here today. I also see members of the media and analysts. Also with us are some of our group board members and of course group exco members. You're also very welcome here. Then, of course, we have MTNers from across our footprint in about 22 countries representing this footprint who will be watching on various channels and listening in to the presentation. After the presentation, you'll be given an opportunity to ask questions. There will be roving microphones that will allow you to ask these questions. We simply request that you indicate which organization you come from and also tell us your name. We will, after this Q&A session, break for brunch. Would ask you to join us in the sunken area, which is on the level just below this one. And then after that, we call on members of the press to join us on the second floor in the CEO's boardroom, where we'll have a press briefing. So without further ado, I'd like to ask you to put your mobile phones on silent or even switch them off. With those few words, it's my greatest pleasure to introduce our Group President and CEO, Rob Shuter. Thank you very much.
Right, good morning everybody. Big welcome from my side to you guys as well, both in the room, on the webcast, those joining us on the Business TV channel, you're most welcome. A big yellow good morning to our MTNers watching also across the footprint. Just to quickly take you through the running order for this morning. So I'm going to spend a few minutes talking about how we see the demographic opportunities, how we're thinking about the strategic framework for the group going forward. I'm going to hand over to Ralph, who'll take you through the numbers, and then, of course, I'll come back for some concluding remarks and also to help us through the Q&A. Before I dive into the strategy and operational view, I thought you might find it interesting to get a little bit of a feel for what we've been up to the 5 months since I joined and since many new colleagues also came in. So I think there were 5 things I really wanted to touch on. The first has been the focus on staff engagement and key appointments. You know, MTN's been through a bit of a turbulent time these last few years, so we put a lot of energy into stabilizing the organization, re-energizing people. We've had a number of key appointments we've had to fill, both at the Group Exco. I think we've brought some great people in, a lot of new talent coming into the South African OpCo as well, and of course some key new appointments across the group, for example, head of procurement in Dubai, a new head of regulatory in Nigeria. So I think we're feeling more comfortable that we're getting the people we need to bring new talent also into what is already a wonderful organization. And I'll show you a little bit later that some of the key staff metrics, engagement, etc., are really going in the right direction. I think the second big thing has been to get to understand the markets. So certainly this has been a big focus of mine. I think I spend more nights on an aeroplane than I have at home. Visited, all 10 of the largest markets, but also, Ralph's accompanied me on a lot of the trips. And we've really, I think, in a more general sense, been encouraging MTN to have a much more external orientation. So being in the field, being with customers, being in the markets, spending time with the distributors, understanding what's happening, the reality, the trading reality on the street. In the end, this is a very practical commercial industry, and you've got to be on top of what's happening in the market. Third big thing has been to understand the business. So obviously we learn a lot going around the market, but there's a lot also of information to digest. And also from my team and I, we're very focused on the accurate management information we need to understand where the business is, so we make the right decisions, so we've got the right strategies going forward. One of the examples I wanted to give you of that is the work that's been done around the subscriber definitions, because this is obviously quite a key thing in the results of the first half. So an example of that is in many markets, we regard a customer as active if they're generating revenue. That's what RGS stands for, revenue generating subscriber. But in a lot of the markets where there's a lot of bulk SMS, often subscribers are only kept active because they're receiving a bulk SMS from somewhere else. And we really feel that this is a bit distorting the reality of the business. So you'll see, for example, Nigeria alone, we took about 7 million subscribers out of the definition of active because they're only alive for this particular phenomenon. Now, this is an ongoing process. We need to finish it by the end of the year, and then we'll have a clean read of where we are, how deep we are into the markets, and what kind of opportunities there are. Another example is the active data subscribers. Historically, we've reported around 120 million active data subscribers. Now, we know that there's some subscribers who only use about 1 megabyte a week. So we call them accidental subscribers. And again, this is not really a good representation of the opportunity in the market. So we've already changed that definition. You'll see in the results, active data subscribers now just around 70 million. So that's a real good measure of what we've got, but it also shows a lot more opportunity perhaps than anybody would have thought historically. Fourth big item has been engagement on the strategy. So that's been a function of discussions with the ExCo, discussions with the OpCo CEOs, our ManCo colleagues, with the board. We've had offsites. We had the whole of the group board in Accra for a few days last month. And we have a new strategic framework, and I'm going to take you through that in a second. Final big focus has been around what we call operational governance. So a large part of this is how do we run the business? How do we set targets? How do we manage progress? What KPIs do we look at? How often do we review the businesses? Who reviews them? What is the business governance, the operational cadence of running these very detail-oriented commercial businesses? So I think we've made good progress. I think we've set out very clearly what we're asking from ourselves, from our OpCos. And we also need to get a lot better at managing the kind of big issues, the events that really come with the territory of managing, in these a large number of complex geographies. So I think we've made a respectable start, and of course we'll keep reporting back, over the quarters and the halves that come on the progress. So let's move to the opportunities in the markets, and I've got two sort of slightly more forward-looking slides. And the first one is what we call a demographic opportunity. So basically what we set out in the slide is across our 22 markets, what do we think we're going to see in the next 4 years leading up to 2020? Now, the one quite interesting thing is the population growth. So basically we're estimating that there's another 45 million people coming into our existing markets in the next 4 years. I mean, that's almost the size of a tier 2 OpCo coming in, just in population growth. Second thing we're forecasting is actually that the consumption power of consumers in our geographies is going to improve. Okay, as we move through, the recessionary patterns, the poor macro, the low oil price, the pressure on commodity prices. In general, we'd like to see that lifting up over the next few years. Now, that's obviously a very key metric when we're thinking about, appetite for new services, for data, affordability kind of questions. I think the last big theme that we see across the markets is the adoption of data and digital services. And these are big numbers. So the basic prediction is that we would get all the way up to 500 million data customers across the footprint in the next 4 years. So the explosion of the mobile internet and the fact that for most of our customers, this is a mobile internet play. Very little fixed line infrastructure in most of the markets. And on top of that 500 million of data users, we are expecting also a big increase in the adoption of digital services. So what do I mean when I say digital service? So if you think about the smartphones that you've all got with you, every icon on your screen is basically the digital service. Okay, and the smartphone itself is connected to the internet. So the real question is, what will the role be of the operators, companies like MTN, in that digital service ecosystem in these developing markets? So that's a little bit about the numbers, the subscriber numbers. I guess the next question is, well, what about the money? What about the revenue? So what we've done on the next slide is, again, predicting where do we think the revenue pools will be in 2020. It's a fairly simple picture. So we've got the consumer sector on the left, the enterprise sector in the middle, wholesale on the right. And I think there are a couple of key messages I wanted to pull out of the slide. So the first thing is that consumers are a big part of the revenue pools across our markets. It's about estimated still to be around 70% 3-4 years out. So I think this quite well suits, you could say, a consumer-centric operator like MTN. But within the consumer segment, you can see that data and digital are going to be the big growth engines. Today, if you look at our results for the first half, we're 55% voice revenue. This is predicting that data and digital together will be more than voice, not too far in the distant future. They're big growth pools, so they're both estimated to grow about 80 billion rand over the 4 years. And of course, what's very critical then is how are we going to arrange ourselves to leverage and take advantage of that opportunity. If you look at enterprise, I think what's very interesting looking at that slide is that the vast bulk of the revenues in the enterprise market is still in voice and data connectivity. Okay, so in the mobile world, we call that managed mobility. And ICT, whilst an important segment, is very much smaller, as you see in that pie chart. So what we feel is critical for an operator like MTN is that we have to build our enterprise business on the foundation of connectivity. It's a little bit sort of going back to our roots. It leverages our scale, it leverages our infrastructure. We put the ICT services more in their proper context as an add-on wrapper service in the more sophisticated markets, but we need a very, very strong foundation in connectivity. Final wholesale, it's a relatively small revenue pool, but the key thing there is that we have a lot of infrastructure, and we need to make sure that we organize ourselves to take advantage of the opportunities to resell that in the wholesale market where it makes sense. So that's a little bit kind of we call this the fish where the fish are slide. And I guess the next thing is, well, how's the group placed in a future that looks like this? Now, of course, we would say that we're well placed. What else would you expect us to say? But I think it is true that the 22 markets we're in are, in general, the right markets to be in. We're in the big markets for our geographies of Africa and Middle East. I think it's also true that we have a good position in these markets. So we're a number 14, we're a number 1 operator in 14 out of the 22 markets. So we've got brand, we've got customer base, we've got infrastructure, we've got good people, we've got a broad range of products and services. So I think we are well placed to leverage the opportunity. And in fact, when you look at these big growth engines of data and digital, I think MTN makes already a very good start. So 72 million active data customers across the portfolio. I think what's also really encouraging is the progress in mobile money. So that's 18 million 30-day active, we call it MoMo, MTN Momo's our M-Pesa, 18 million 30-day active MoMo customers across the portfolio. That's up, just short of 20% in the half. So I've got a slide on that a little bit later. So last part of the puzzle then is, well, how are we going to arrange ourselves to take advantage of these opportunities? And that's where we've done the work on the strategic framework for MTN. And basically, we've come up with 6 very operational pillars upon which we'll base the strategy. And we've grouped them into the acronym in the slide that just popped up in front of you that we are calling the BRIGHT strategy. Okay, it's got a nice smiley face for a bright Thursday morning here in Johannesburg this morning. So a couple of things. I mean, firstly, you see we make an effort also in how this is communicated, okay? This is largely for the people in the company. We need to give them, hope and inspiration. We need to make it memorable, easy to recall. This classic thing of, what's the strategy? You want to ask someone in an elevator and they say, okay, the strategy is this. So the MTN strategy is BRIGHT. 6 operational pillars to build our business, to take advantage of the opportunities I've just described in the markets. What are the elements? Number 1, best customer experience, NPS lead, lower churn, higher market share, return and efficiency, capital efficiency, ROIC, etc. I've got a slide on each one of them, so I'm going quickly now through them. Ignite commercial performance, the commercial agenda. The retail is detailed commercial leverage of the business. The G's, the 2 big growth engines of data and digital. The H, hearts and minds, culture, people, high-performance culture, minds, reputation, stakeholder management, risk management, regulatory. And finally, of course, as a technology company, the T in any acronym has to stand for technology excellence. So very quickly on the BRIGHT elements, the B. I think the thing I wanted to stress on this slide is this is a very commercial objective. Okay, of course, we want customers to have a great experience. We want them to feel good about doing business with MTN. We want our people to feel good about serving customers, but we also have a commercial agenda. And the big hidden cost in a P&L of a mobile operator is churn. Okay? So the operator with a sustainable NPS advantage has got the best chance of having a sustainably lower churn, and has got the best chance of, over time, slowly taking value market share in the key segments. How are we doing? There's a snapshot of that across the bottom of the slide. So there are 7 large opcos. So you see only 2 have a number 1 NPS, and at least there are 2, because Iran just jumped into the number 1 in the half. So there's a lot of work across the rest of the markets, and there's a lot of work even across the markets that you don't see on the slide. So in a way, when you look at an ambition relative to the current reality, to have a 10-point NPS lead across all our markets, we are quite far away from that. We need to be honest and straightforward about that. But this is absolutely something we're going to put a huge amount of energy into. The R, return and efficiency. I think the key thing to remember is we are a capital-intensive industry. You know, you see in our results, we're putting 30 billion rand of capex into networks and IT across 22 markets in 12 months. So in our industry, the return on capital, and in particular the marginal return on the marginal capital, is a very, very important metric. It informs a lot of things. You know, where do you spend? How much do you spend? How do you allocate scarce resource between technologies, between countries, between rollout capacity, coverage? So it needs to be much more an art and a science in a company like ours. Second thing, total shareholder return. So of course we're very much aware we're competing for the attention of investors with other emerging market mobile-centric telcos. So, you know, we want to outperform our peer group. We want to deliver the alpha within our macro environment. Third big focus is around cash flow. So adjusted free cash flow, operating cash flow, any form of cash flow is going to be a big focus, okay? Because in the end, you know, cash is king, they say that, of course. But also for MTN, you know, we have to be generating the right amount of cash out of the operations also for, you know, the funding of the group and gearing and dividends and all of these kind of things. Now, the concept I wanted to introduce on the bottom of the slide is the concept of the cash ratio. So it's the simplest metric in the world. We take the EBITDA margin and we minus the capex intensity. So it's the percentage of revenue that's left basically after your expenses and your capex. And why it's an important measure is because it helps us to manage the margin and the capex as one combined topic and not as sort of 2 parallel streams. So that's important. But the second thing also is we need to recognize that as we move into particularly the digital service world, they have often a different economic profile. So maybe the EBITDA margins are lower if you're you know, selling a curated streaming service in a particular market. But of course, the capex is much lower as well, because this is not carrying the big kind of GSM capex on the network. So I think if we more and more focus on the cash ratio, we'll take a lot of noise out of this, these different attributes. Moving to the I, so ignite commercial performance. So I guess there's a couple of things in here. The first thing is that we're building off the existing Ignite program. So the Ignite program was all about getting the right kind of commercial, financial, operational performance out of the 2 big markets, South Africa and Nigeria, over 2017 and 2018. We want to extend that sort of conceptually across the whole portfolio and focus on the commercial performance. So what would we be looking for? Subscriber growth. We're looking for the number 1 or number 2 position across all the markets. And we're looking to take a disproportionate share of the value in revenue and EBITDA. What are the key things that would go in there? So one very, very important thing is what we call the segmented go-to-market. So basically, to have the right segmentation model for consumer with the right channel differentiation per segment, the same for enterprise. So as I described earlier when we looked at the revenue pools, we are big believers in voice and data connectivity-centric enterprise business. So this means we need to resegment our base and we need to arrange ourselves to take advantage of that. And that's just, you know, it's network, it's distribution, it's a product portfolio, it's the commissioning into the indirects. It's a whole science there. So if you're thinking Ignite commercial performance, build on the Ignite program, segmented go-to-market, and a big focus on retention and base management. You know, we tend to be an industry often that is very what we call acquisition-centric. So we're all kind of pouring in gross ads every month or every quarter. We need to rebalance this industry, so we're focusing also on retention-based management. This is the world of customer value management, CVM. This is the industry speak of this kind of activity. We've got a nice program together now to up the CVM skills and resourcing across the opcos. You know, our campaign intensity is too low. We don't have the right campaign engines. We don't always have the kind of MI that we need. Commercial performance, how would we say we're doing? Well, I think the net ad story is very much distorted by all this work we're doing on subscribers. You know, and it's frustrating, I think, for us that we're not all the way through it. I'm sure it's frustrating for you. For sure, by the end of the year, we're done with this clean subscriber numbers, and you'll see the real kind of net ad performance across the group. Market position, as I said earlier, you know, we do have strong positions in our key markets, but, you know, where we're not number one, we need also to have a path there, particularly in the key segments. Next one is the G, the growth through data and digital, and I'm sorry, I'm kind of cantering through this because Ralph has much to share with you on the numbers. So as I said before, data and digital is two different things. The one is access data, internet access, mobile internet. The other one is digital services. Key metrics, data subs, digital subs. So that's rapidly expanding the base. This is critical. And the third measure is basically the digitization of how we operate. So moving your channels from physical to digital for sales, for service, app, USSD, IVR, online. That is a whole, you know, program in and of itself. I've spoken a bit about the data users on the left. On the right, on the MOMOs, I think it's quite encouraging to see Nigeria coming through in the half. So putting on over 1 million subs in the first 6 months. So they're now 11% of the MOMO subs. Couple of little sound bites for you on the MOMO world. So I told you it's 14 markets. They're on one industrial strength mobile money platform. In June 2017, we processed 170 million transactions across those markets. So that's 4,000 transactions a minute. So already there's quite a lot of scale in the business. Total value of transactions June 17 was more than $4 billion. So of course we've got a long way to go. We very much accept that. We need to make progress in the big tier 1 markets, which is early days. But if you go through the tier 2s, you go through the Ghana, Uganda, Rwanda, Cameroon, you really see a lot of traction in the mobile money business across MTN. Hearts and minds, the two halves of it. I spoke a bit about the employee engagement, motivation, morale. I think it's quite nice if you look at the chart bottom left. So the eNPS, would you recommend MTN as a place to work to your friends and family? You know, from a kind of around about 2, we've jumped all the way up to 30 in 6 months. So, you know, that's, I think, a big standout for our OpCo CEOs and OpCo management teams, because they are the guys that are really keeping their people engaged and motivated, often in quite difficult circumstances. And if you look at our engagement scores across the group, again, you know, a nice lift in the first half. So I think some real green shoots on the people engagement side. The mind part is really all about the reputation management. We're putting some good people in place. We've hired a head of the group regulatory, Faleng, who's here, I'm sure, with us in the front row. We've approved a whole structure for Faleng to assemble a group regulatory and public policy team. We're upskilling public policy and regulatory across the markets. This is a space that you need maybe a few, but very smart, very experienced people. You need to be very much on top of the regulatory and public policy agenda. Final topic, technology excellence. So it's not just about the mobile network. Of course, that's super important. So number 1, network NPS is exactly the right metric. We're very focused on voice quality as well. Telcos have got a habit of running so far and quick into the data world that they forget that a large part of the perception that we all have on the quality of the network is the voice quality. You know, how is the call clear? What's the setup? What's the drop? What's the voice coverage? Very, very important metric still. So you see there the progress in the bottom part of the chart. 2G, 3G, DCRs, significant improvements across the entire portfolio. But of course, it's also about the data experience. And where we write their quality data sessions, those three words quite carefully selected. Okay, so at MTN, it's not about this kind of nuclear arms race to have the fastest 4G download speed in a particular place. Okay, it's about the customer experience of the data session. You optimize your network in a different way depending on whether you're, chasing a headline or you're really worried about the customer's app experience. Because let's be honest, most of our data experience on a smartphone is in an app. We're in YouTube, we're browsing in Google, we're downloading emails off the email server. Last thing on technology excellence is just to re-emphasize the central role of IT. So often, the network experience can be perfectly fine, but customers like us are having a technical experience of an operator basically on their IT environment. Billing, charging, the app, the experience in retail, the experience when you call a call center, the time it takes to resolve a query. This is all a function of your IT estate. And this needs really also to be optimized if you want to build this #1 NPS across the piece. So that's a whistle-stop tour through the Bright strategy. We are going to continue to work on this in the second half. We're looking for much more specific project plans, KPIs, milestones. We're going to report like this. We're going to organize like this. We're going to run the business like this. And we really believe that these are the 6 big things that will drive the operational performance and leverage the opportunity in the markets. Okay. I'm over my time, but I will keep going for a few minutes. Our results for the first half. So very much relying on Ralph to take you through the detail of it. I wanted to point out a few key things. 1, group service revenue, constant currency. Okay. If you're wanting to get a feel for the operational performance in the markets, that's the place to look. 7.5%, we think it's a respectable result. Of course, when you look at the reported numbers, that's a negative number, and that is really as a result of the big depreciation of the local currencies in the last 12 months. So we are simply translating back into rand a much smaller amount for the same amount of the local currency. Give you an example of it, the largest market we're translating back is the Nigerian market. The Naira is depreciated more than 70% year on year. Okay, so you're just not getting back into ZAR, the Naira that we got a year before. But, in your packs and in the reporting, you have full details of both reported and common currency. So, of course, you make your own judgments. 2 big growth drivers, data and digital, common currency, again, looking at the performance across the markets. Group data plus 32%, group digital plus 25%. So what we were saying this morning is we think it's an encouraging start for a multinational operator who's staking out a strategy based on these 2 big growth pools of data and digital. Group CapEx, 10 billion spent in the first half, so we've got 20 billion to go in the second half. I think the final thing to pull out of the slide is we've reconfirmed also the dividend guidance for the full year, and therefore have declared an interim dividend of 250 cents per share. A few quick comments on the commercial performance in the large markets. South Africa. So we try and tell a story just in the heading. We say supported by prepaid growth. South Africa's had a very respectable performance in prepaid. Service revenue up 9%. Solid performance in the net adds. Good commercial momentum. And I think in general we've got a prepaid business to be proud of. But we all know we have a tremendous amount of work to do in the contract or postpaid market. So if you wanted to get one at least green shoot, you see top right of the slide that we have positive net adds for the first time in a long time. So that's telco speak. It basically means we're not losing customers anymore. In fact, we marginally added some customers in the half. In that contract market, there are really 2 big pieces. There's the consumer contract market and there's the enterprise contract market. And the enterprise piece, I think, is where much more of the pressure is in these numbers. In fact, consumer contract is also looking much more positive. I think a couple of other standouts in the South African results, 18.5% growth in data revenue. So pretty respectable, benchmarks pretty well against what's happening in the industry. Network quality is much improved, and you see also good progress on the site rollout, 3G, 4G sites. And I think in South Africa, for sure, we're in good shape to get our way through the CapEx program that we announced even from the beginning of the year. So the South African CapEx program has not been re-estimated in these results. And finally, of course, good to see some commercial momentum. Hopefully you've enjoyed at least a good company stepping behind the Springboks, who really needed a lot of support. And we were very proud also to win the Brand of the Year in South Africa just in these last few days. Second, to talk about Nigeria. So again, a story in a heading, focus on healthy growth. So what do I mean by that? So what's in the healthy? I think the one big thing is we're cleaning up the sub-definitions. I discussed that already. We also have quite a big business in value-added services, and we've really been optimizing that business a lot in the 6 months. You know, trying to be much more attuned to what customers are looking for. So things like double opt-in if you buy a service, things like a very crisp summary of the various services that subscribers have opted in for. It's as easy to cancel a service as it is to put a new service on. Do not disturb lists have been implemented. So it's depressed a little bit the revenue in the first half, but I think we have the right base to grow from going forward. Big standout in the Nigerian results is the data growth. So plus 70%. So that's been depressed for quite some time with various regulatory changes, data only on an opt-in basis, some pressure in the market itself, a lot of competition. I think within that tough market, our team in Nigeria have done, really a good job commercially. And if you look also at the network and the site rollout, we're one of the few operators that is still basically investing for the long term with the support of the group. Finally, on MTN Iran Cell. So that's really a story of consistent execution, very disciplined business, very well run, very, very tight. Consistent progress in net adds, standout performance in data revenue, 68%. Good progress also in the digital space. Good progress on rollouts. And as Ralph will share a little bit later, I think also good progress in making sure that as MTN Group, we can bring back the funds, the returns, the loans, the dividends from our success in that market. So with that as introductory, I hand you over to Ralph, and I'll be back in a few minutes.
Rob, thanks very much, and very good morning to everybody here. Nice to see some familiar faces in the crowd, and to all of you here at 14th Avenue and those who are joining us streaming in either via TV or on the web, I want to extend my welcome as well. Over the next 20 minutes, I want to take you through the financial highlights for the year, half year under review. First of all, want to take you through the significant items that are impacting our results. There are about 4 significant items that I think explain a lot of our financial results as you look at them from a reported basis versus a constant currency basis. I'll then cover some of the salient items on the income statement before looking at the main financial KPIs of our 3 key markets, South Africa, Nigeria, and Iran. I'll then go back into the income statement, cover the key income statement lines, put a bit more detail on them, and explain some of the key movements, and then finish off looking at our balance sheets as well as our cash flow. So let's start. As I mentioned, there are 4 major factors that we believe have affected or impacted our half-year results. And the first one is the point around weak local currencies relative to the rand and the US dollar. And if you look at all our operations, across the 22 opcos, relative to the rand over the period, they've all weakened. And so the first major impact of this is that you'll see that our reported results are lower than our constant currency results when you look at it from a point of view of revenue and EBITDA and other of the main KPIs. And obviously, we've been talking a lot, and Robert's been talking a lot about constant currency growth. And constant currency, in our view, provides better visibility of the underlying operating performance of the business. The second major impact you'll see is particularly in Nigeria, where the weaker Naira has had a significant impact on our network OPEX, and this has resulted in lower margins than you'll have seen at the end of December 2016. December 2016, many of you will remember a Nigeria EBITDA margin of 40%. The second impact is really one-off items impacting basic earnings. And here we have positives and negatives. And the first positive is that we've had approximately 6 billion rand coming through into EBITDA related to the profit when we had the exchange of a 51% shareholding in Nigerian Towerco and exchange that for shares in iChess Holding. So that was a positive. But on the downside, we had asset impairments in Sudan and Syria of 1.7 and 1.1 billion respectively. These asset impairments relate to carrying values previously written up to account for the impact of hyperinflation exceeding the calculate value in use. Below the EBITDA line, we have goodwill impairments totaling 2.6 billion rand, and these come through for Afghanistan, Yemen, and Sudan. The operating environments in these markets have been very challenged and necessitated the impairments. The third factor is what we call non-operating items impacting headline earnings. And as you will recall, we fully expensed the Nigeria fine in 2016. However, there's still the accounting for the interest unwind relating to the fine of some 537 million rand in the first half of the year. And we've had forex losses of the tune of 1.5 billion. 600 million of them relate to the repatriation of cash from Iran. And the final major factor is the disposal of AfriHost. We disposed of AfriHost, which was an operation under South Africa at the end of 2016. And so the reported growth rates that you see in your pack will be much lower than organic. And when I make commentary around the South African operation, looking at the service revenue, EBITDA, etc., that will be a basis on the organic. And I think that gives you a better reflection of how the business is truly performing from a South African perspective. So let's start and have a look at some of the salient points of the income statement. And the table that you see here has reported in constant currency growth rates at the far right hand of the chart for some of the income statement lines. And so you'll see that we have a solid constant currency growth rate of 7% for revenue. And if you look at service revenue, that's a solid 8%. But on a reported basis, the revenue growth was down 19%, as well as similar for service revenue growth. As an example of this impact of weaker currencies, the Nigeria revenue translates to the rand for group consolidation in this period 38% lower than prior year. In that income statement, the other income line you see there of 6 billion rand relates to the gain on the exchange of Nigeria Towerco for shares in iChess that I mentioned previously, and that's a once-off positive impact to basic earnings. I'll unpack the other elements of the income statement later in my presentation, as I mentioned, but let me close out and talk and refer to the interim dividend. As Rob has mentioned, the board has declared an interim dividend of 250 cents per share, which you'll see at the bottom of your table there. And this interim dividend is in line with the 2017 guidance, which we have maintained. So, as I mentioned, starting to look at our big markets and starting with South Africa. The chart that you see here illustrates the service revenue, expenses, EBITDA, and CapEx trends over the period under review. And as I mentioned again, the South African operation here is excluding AfriHost. So all the measures here are on an organic basis. So service revenue was a solid 5.2%, and this was driven by good data growth of 19% and digital revenues that grew strongly at 38%. The data revenue growth was driven by an increase in data traffic. We saw data traffic growing by 56% year on year, and this was at the back of sustained investment in the network and the prepaid net adds that we saw in the first half. The growth in digital revenue was driven by the extra time offering that we took to the market in the second half of 2016. Voice revenues were down 5% year on year, and voice minutes declined 11% during the period. If you look at expenses, cost of sales were overall lower in the first half in the same period, and this was mainly driven by lower handsets sold, lower subsidies on the handsets, and obviously a stronger rand having an impact on handsets that are imported. The growth in OPEX, this was largely driven by network. We're expanding our network, we're growing our network, as well as marketing expenses. When you look at the network, we had unitary cost increases both for rental and electricity. And as I mentioned, we rolled out an additional more sites, both for our 3G and our 4G network. The EBITDA margin that you see that increased, this was largely a function of the decrease in handsets cost of goods sold. But the increase in prepaid data and extra time revenues was also supportive of margin over the period. If you look at CapEx intensity, in the period it was lower than planned. However, we believe that with the acceleration, and as Rob has mentioned, we certainly see the South African operation fully meeting its CapEx intensity as it looks to complete its investment program for 2017. So moving on to Nigeria, we recorded a solid 11% growth in service revenue in the period. And this is a very solid result considering the tough macro environment in Nigeria. It was encouraging to see that we continue to see growth in our core voice market, where we had 4% growth in the period. Voice represents about 63% of current total revenues in Nigeria. So that growth, would have been pretty supportive on margins. We had solid data revenue growth of 70%. This clearly illustrates the significant opportunity that Rob spoke about earlier on around data. And, when you look at that revenue stack bar, you see that, data is still, relatively small in a market such as Nigeria. The significant increase in the 3G and 4G network, really has closed the gap in the major metros where, we're probably behind some of our competitors. And obviously in these markets, in these metros, that's where you find the higher ARPU data subscribers. In terms of expenses, what stands out is the growth in OPEX over the period, and this was driven by the network expenses. Now here there are two main drivers, underpinning this growth. The first is that there's a significant component of expenses are US dollar denominated, and with the devaluation of the naira against the US dollar, unit increases obviously increased. The second is that we've had the significant rollout both for our 3G and our 4G networks over the period. Now, thinking about what proportion of network expenses are of the total OPEX for Nigeria, the number there is about 63%. So quite a significant part of the OPEX is network related and would have been impacted, by the devaluation of the naira versus the US dollar. This network expense growth has been the most significant driver impacting the margin decline that you see there in the chart. We have had, a few one-off expenses that in aggregate would have impacted close on to 1% negatively to the margin that you see there achieved at 38.3%, for the half year. In terms of CapEx intensity in the period, it was higher than last year, but lower than we had planned. Although the US dollar liquidity in Nigeria remains constrained, we currently have sufficient funding facilities for our CapEx rollout and program, for the balance of 2017 and going into 2018. So moving on to Iran, we saw consistent performance for the business, with service revenues continuing to grow in the teens, up 16% year on year. The key driver here, as you can see in the charts, is the 70% growth in data revenues. There has been significant investment and build out of our 3G, in particular our 4G network, that has underpinned the data growth, as well as the strong net adds that you'd have seen in Rob's earlier slides. Digital revenue growths were more muted in the first half. We've had, as a start of the beginning of the year, new opt-out processes introduced, as well as more onerous regulatory approvals required for some of the VAS products in the market. When you look at expenses, or when you start to look at cost of sales, we've had an increase in handset costs as a result of taking out to the market more 3G and LTE modems sold, and some of these had a negative margin. The growth in data traffic has put some pressure on OPEX. We saw an increase in data traffic of close on to 190% year on year in the Iranian market. That data growth has resulted in increased transmission expenses, and the business is required to lease the long-haul capacity from TIC, the government-owned fixed line operator. The OPEX has also increased as staff salaries were adjusted to meet more of the market benchmarks. The EBITDA margin drop that you see there of 1.4% is mostly driven by the transmission expenses that I referred to later. The accelerated rollout of the network to meet the data demand that we see in this market is putting some short-term pressure on cash flow. But the capex intensity that you see at the half year, we'll see this moderating in the second half. So going back to the income statement, and I'll start with service revenue. The service revenue bridge that you see on the chart here shows on a year-on-year growth of the various revenue streams, starting with the reported H1 service revenue at the far right hand of your chart that you see there, and then builds out the constant currency growth rates of the three main revenue bearers there, voice, data, and digital, and then adjusts for FX and hyperinflation, and ending off with reported H1 2017 service revenue. This format of reviewing constant currency performance whilst reflecting reported results is one I'll use consistently in slides that will follow. So let's have a look at service revenue. Data and digital revenue were the key drivers of growth in the period. Data was up a solid 32%, so a healthy 25% growth in digital growth. And just looking at data revenue growth, this was boosted by the significant rollout of our 3G and 4G infrastructure, net add growth that we saw in several markets, value for money propositions that we've taken into the markets as well. Our active data subscriber, as Rob mentioned earlier, stands now at 72 million under our new definition, and we've seen here average MB per month usage of more than 100% over the period. So really seeing the pickup off relatively low bases here. Digital revenues were underpinned by the strong mobile money subscriber growth that Rob mentioned earlier, as well as the extra time offerings that were launched both in South Africa and in Nigeria. Whilst outgoing revenues were largely flat in the period, we continue to look at ways to optimize our voice pricing whilst taking advantage of the demographics in our market. This allows us to mitigate over time on the voice revenues, given that there's still a big part of our revenue base going forward, pretty much echoing some of the points that Rob raised earlier. Let's have a look at expenses. Here we take a look at group expenses, firstly on the top chart, looking at the cost of sales and then operating expenses. During the period, cost of sales were flat, which is a really good outcome considering the competitive environments in which we were operating in. The handset costs stood out, declining almost 600 million year on year, supported by the strong rand and stable handset subsidies in some of the markets where we have handsets coming through our income statement. This would, however, swing the other way, if we saw a period of rand weakness in the second half of the year. The year-on-year increase in commissions and distribution was mostly driven by the growth that we saw in our mobile financial services business across several of our markets. Moving on to operating expenses, we saw an increase of almost 24%, with network costs being the key driver of this. This was again driven by the network rollout, as well as the increases that we saw in the key markets of South Africa and Nigeria that I previously mentioned. If we move on to EBITDA, on this slide you see the key drivers of group EBITDA, both in absolute terms as well as from a group margin perspective. And you'll see South Africa grew EBITDA margin by a decent 13%, and this is on the back of service revenue growth as well as the margin expansion that I mentioned previously. Nigeria EBITDA declined 15% in rand terms, and this was driven by the Naira devaluation and network OPEX, and overall group EBITDA was down 3%. Group EBITDA margin was mostly impacted by the Nigeria EBITDA margin, as you can see there on the chart, 4.4% impact. The profits from the exchange on Nigeria Telco, as well as the impairments for the hyperinflated assets in Sudan and Syria, are more once-off nature, so a more reflective way of thinking about our margin, our operating margin is the 32.9% that you see there highlighted in the chart. If we move on to finance costs, there are three main drivers to the lower finance costs that we reported over the period. This is lower FX losses, the rand strength was a factor, and there's a change in the mix of debt across the group. And so if we start with the FX losses, during the period we saw a reduction in FX losses of close on to 2 billion rand relative to the prior period. And this decline was largely as a result of lower foreign denominated receivables in Mauritius following the repatriation of funds from MTN Interim. The forex losses in the period under review also included an amount of just under 600 million rand that I mentioned before relating to the repatriation of the rand dividend and the short-term loan from MTN Interim. In terms of the stronger rand against the dollar in the same period resulted in lower rand reported finance cost on US dollar denominated debt. The debt translation of Nigerian finance costs following a weaker Naira also resulted in lower rand reported net interest paid. When we look at the mix of debts over the period, the Naira debt decreased from 14% to 8% of total group debt, whilst the US dollar debt increased from 38% to 48% in the period. This swing in the relative composition of our debt away from high interest Naira debts towards the lower interest US debt has affected the lowering of our average cost of debt. And as obvious, the stronger rand has also had an impact both in the mix of debt and the average cost of debt that you see there on your charts. If I move to JVs and associates, I think the first thing that you'll see there in the charts is the lower contribution from Iran, and that was a result of two factors. Firstly, a lower profit after tax, as well as the depreciation of the real versus the rand. We repatriated over 12 billion rands of MTN Group cash from Iran's bank accounts over the past 12 months, and this has resulted in lower interest income earned for the JV. In terms of the tower companies, and you see that line over there in the charts, we saw a big year-on-year improvement. In the previous year, the Nigeria Telco, which is now part of IHS, incurred unrealized forex losses following the depreciation of the Naira. The operating losses we see across our digital businesses are largely in line with prior year. These businesses are building out and gaining scale. However, given the rand strength, the reported results would reflect better, as you see there in the chart, an improvement year on year. And again, as you can see, the depreciation of assets previously written up for hyperinflation in Iran have decreased the reported share of our results for JVs and associates, but higher obviously than the prior period. Looking at tax, when we look to reconcile the tax rate, I think there are a couple of points to note here. Firstly, the tower profits of 6 billion is non-taxable. The standout point here that you'll see is Sudan. There's an impairment of Sudan assets coupled with Sudan turnover-based tax, which renders a large proportion of expenses non-deductible, and this has an impact on the group effective tax rate. With withholding taxes here, of 7% are up on cash upstreams to the group. And the way to think about more of our normalized group effective tax rate, barring any unforeseen circumstances, will be the low to mid 30s at a group level. If we move to headline earnings per share, and this will complete my review of the income statement. This table you see here provides a reconciliation of basic earnings per share through to basic headline earnings per share that reflects more visibility on the operational performance of the business. And if you start at the top of the table, you recognize the reported earnings per share there of 290 cents for the first half of 2017. If you walk your way down the table and you adjust for profits and impairments recognized in earnings, we end up with the reported headline earnings per share of the 217 cents. If we adjust that further with all the non-operating items, that is the Nigeria interest unwinds, and there's an impact there of 24 cents. There's a hyperinflation impact of 42 cents, and there's an impact of FX loss of 70 cents. We get an operational view of headline earnings headline earnings per share of some 353 cents. And if you then make the same adjustments for the prior period, I think you'll see there as you walk down the table that you'll get at 358 cents, implying a year-on-year decline of 1%. And this 1% decline does not exclude the impact of local currency weaknesses embedded in translated group earnings. And we think that this view of operational headline earnings gives you a better reflection of the true underlying earnings generation of the business, and we'll report it as such going forward. Let's now move and have a look at the balance sheet. During the last 6 months, we had PE additions of 9.5 billion rand. We took on impairments of 2.3 billion rand, depreciation and amortization of 9.6 billion rand, and had foreign currency translation reserves being recycled of 3.1 billion rand. And all of that resulting in a net decline over the period under review. Goodwill and other intangibles decreased in line with the impairments taken in the period, as well as the strong rand. The exchange of Nigeria TowerCo shares into IHS Holding is the major change that you see there in non-current assets. We fair valued our IHS Holding at 25 billion rand as at the end of 30 June 2017. Looking further down the table, our interest-bearing liabilities have come down, driven by lower Nigeria debt that I mentioned previously, as well as a stronger rand versus the US dollar. Our net debt has remained stable over the period. We have less than 10 billion rand of maturities due from the second half of this year all the way up to 2020. And all our group funding activity at the moment, is focused on refinancing and rolling over existing debt. And we're using our refreshed DMTN program for most of the funding activities, as you'll have seen in the markets in recent times. So let me close off the financial review with looking at cash flows. And here you have, the cash flow bridge. And this bridge shows the key movements in operating, investing, and financing activities that you can see on the chart there. So you'll see that operating activity generated 12 billion rand. We invested 12 billion rand of cash capex, in the periods. So there was 2 billion of capex from last year that came through. That reconciles the 10 billion rand that Rob spoke about. And the net impact of our financing activities was an outflow of 1 billion rand, resulting in a free cash outflow of just under 2 billion rand in the period. Within operating activities, what stands out is the repatriation of Iranian dividends of 6.5 billion rand in the first quarter. The 2016 final dividend of 400 cents per share resulted in the outflow you see there of 8.5 billion rand. And the cash capex of 12 billion rand, predominantly is financing the investment activity in the network across our markets. From a financing point of view, as I mentioned earlier, our activities is mostly focused on refinancing and rolling over existing group debt, so very limited change there. We have outstanding cash repatriations from Iran, where we expect flows over the next 6 to 9 months of over 5 billion rand at current exchange rates. And we're continuing our focus on cash upstreaming, OpCo dividends upstream to the group, management fees where we have management fees, intercompany loans being repaid. And post the end of June 2017, we have had dividends being declared by many of our opcos. We've had dividends declared by Ghana, dividends declared by South Africa. Nigeria declared a dividend in July, and very pleasingly, we saw a dividend being declared in Nigeria for the proceeds for the group at about $98 million. And we've been very encouraged, with, although still a bit constraints, but improved liquidity since the opening of the I&E window in Nigeria. So, I mean, those, dividend upstreamings from the opcos as well as management fees, have been very encouraging over the period. We further have the Ghana localization process in the second half of this year. When we received our 4G license in Ghana last year, the condition was to localize up to 35% of the business. We're far advanced with that process, and any proceeds that come from that localization will be upstreamed for group corporate purposes. And with that, that concludes my financial review, and I'll hand over back to Rob to make the concluding remarks.
Thanks, Ralph. Hopefully you found that useful. I think the MTN results are always a little bit confusing. There's so much things, coming in and out in FX. So we made a big effort to at least try and get them as clear as we could. Just two more slides from me. I think the first thing is to talk through a little bit the 2017 guidance. So we're basically confirming pretty much most of the elements. SA service revenue growth mid-single digit, so we're on track for that. EBITDA margin up 0.5% to 1%, we're on track for that. Nigeria up a single digit, clearly 10.8, we're on track for that. We had a capex estimate of 34.7 billion, which we've reduced to 30, and largely as a result of a little bit, struggling with the dollar liquidity in Nigeria. We pulled back some of the group capex, but generally we're obviously still trying to invest in the business for the future, and we've confirmed the dividend guidance for the full year, as I discussed. So I think kind of steady as she goes in terms of the specific capex for 2017. Final slide is looking a little bit forward into the remaining, what's only now 5 months of the year. So I think three big focuses for myself, the management team, and all our MTNers. Big one is to entrench the Bright program. So we need to land the Ignite program, particularly in South Africa and Nigeria, to make sure we set the right foundation commercially for the following year. The work in delivering the NPS lead across all the markets, we're really looking for now a very practical program that will, push through those improvements. So that needs to get into the kind of do this by then, manage progress, etc. kind of mode. On the data, I think the one last thing I wanted to introduce on the data strategy is the concept we've been calling the dual data strategy. And that's basically what you're seeing is that we're very focused on the high-end customers, already largely in metro kind of areas. That's a big sort of 4G high-end smartphone story. That's a large part of where our 72 million customers sit today. At the same time, we're very much committed to bringing the next 50, 100, 200 million customers into the data world. And we very much realize that that is going to be largely, peri-urban, rural customers, largely on lower-end 3G devices. So we need a kind of a coverage, commercial device strategy if we really want to push this democratization of data down through the next few layers of the customer base. So we call this a dual data strategy, volume and value. There's a lot of work to be done there. Accelerating enterprise, the pivot back to SME-focused fixed and mobile connectivity.
what's happened in Nigeria from a CapEx perspective? And then just one final question. Obviously, the impairments that you've made to certain opcos, how many of the opcos are actually loss-making at the bottom line? And do you have any views on restructuring or asset sales yet?
Okay, well, let me start with the first one I remember. So the incentive programs for the senior management, I think, all fully described in the financial results of last year. This is basically the scheme we walked into. So for the short-term incentive, Group Exco, our colleagues here in the head office environment, we really have a single metric, which is the group attributable earnings for the short-term incentive. For the long-term incentives, this has historically been a combination of operating free cash flow growth and total shareholder return. In our board meetings of the last few days, we've approved that for the next cycle on the long-term incentive, we will rather focus on 4 metrics, and they will include now revenue, EBITDA, the total shareholder return, and the cash flow. So that is a much more, I think, balanced approach. And we will have a similar structure also for the executives and the management team for next year's short-term incentive. But, we're 7, 8 months through the year, so we have not made any changes for the existing STI. And remind me on your second question. Yeah, so I think just a quick answer to that. So the impairments really are in 2 spaces. There's the impairment of assets and equipment that only comes when you've already worked your way all the way through the goodwill, and that was the case for the Sudan and Syria impairments. The goodwill impairments were the other markets that Ralph referred to. Generally, these are all our Middle Eastern so-called conflict markets. I think we've had a good scrub through the impairments and the carrying values in this half, and unless there's sort of new bad news, significantly bad news the next years or so, I think we're pretty comfortable with how those calculations have been made. I think, the final part of your question around portfolio, big focus for my team and I has been to get the right performance out of the countries we're in. So this is a very operational strategy. I guess towards the back end of the year with the board, we look at the portfolio as well. But I really believe that we need to show that we can be great custodians of these assets, even when they're in difficult markets and difficult macro. Build up credibility as an operator of emerging market telco assets. Then maybe, in the future, we can look at whether we can expand the portfolio depending on consolidation in the sector. JP. Okay, let's just take JP and I, and then we'll come back to the back.
Thanks. Good morning, JP from JP Morgan. 2 questions and 1 clarification, please. So the first question, just around your cash ratio and the philosophy you have around your cash ratio. So is it more a save to invest mentality or more an invest to grow mentality? Are you going to see EBITDA savings before you invest in CapEx, or invest the CapEx to grow the business and push the margins up through that? The second question, maybe a little bit tougher, is if you pull together all of what you said around Bright and the demographic opportunity, etc., what is your blue sky aspiration in terms of what this group could look like looking out, 5 years? Is the earnings number today, can that be factors higher 5 years from today, or is it sort of incremental gains from here? And then the last question, or the last one, is just a clarification. The R7 dividend, is that a cash dividend, or could you contemplate a scrip element to that? Thank you.
Okay, JP from JP. So I think the first question around the cash ratio, I think, at one level, it's just a simple rule of thumb. Because often what we do in our industry is we look at an OpCo and we say the margin's 35, that kind of looks okay. But if the margin's 35 and the CapEx is 15, then 20 is flowing through to cash, that's a good result. If the margin's 35 and the capex is 36, that's not a sustainable result. Okay? So we're just trying to encourage ourselves, and maybe in time also obviously those that are following the stock, to look at the net cash coming out of the two components. I think that's the first point. The question on the orientation, I think when it comes to OPEX and resources to build out the new businesses, I think we are very much in the save to invest mentality. Okay? What we can't do is put a whole lot of new operating expenditure on top of an existing OPEX envelope because we're going to put huge pressure on margins. So we are going to have to be more efficient in the core business, and we're going to have to make trade-offs and choices. Now, of course, it's not binary. It's not one or the other, but you ask for a general orientation. I think when it comes to CapEx, though, it's a little bit different because, here we are playing the long game. We want these positions, we want these operations in these countries to be positioned to take advantage of these opportunities, in a 3, 5, 10-year kind of horizon. So you've got to put the infrastructure in that enables you to be competitive. Within the existing capex envelopes, though, what you see is, say, the 34 billion that's now down to 30 billion. Within that 30 billion envelope, we think we can do a lot. So I think in the capex space, it's going to be much more around what do we take an existing investment envelope and how do we allocate it? And how do we use smart measures in that allocation? That's why I spoke a bit earlier in my comments about, the marginal return on the marginal capital. We've got to be really so scientific about whether the next 3G U900 site goes there or there. We can't just say, okay, it's 100 sites, we hope for the best. That's not going to work for us going forward. Times are tough, and we've got to turn every rand over 3, 4 times and make sure we put it in the right place. I think the long-term vision for the business, I guess what we're trying to do at this stage is at least to sketch it at a kind of a conceptual level. Okay, what I speak a lot about in the business is the 100, 200, 300. Can we have 300 million customers as opposed to the 230 now? That needs population growth, but it needs market share gains. We need to outcompete the competition. Of the 300 million, can we have 200 million active data customers? That's 2/3 of the base. Today we have 70 of 230. And finally, of the 200 million, can we have 100 million actively using an MTN digital service, whether it's mobile money or streaming or video or entertainment, whatever it might be. So, we're basically going from a kind of an 1870, 230 world to a 100, 200, 300 world. That if we execute that deliberately, we keep a good eye on the OPEX and the CapEx, we manage the business well, I think we can really, generate a very good performance out of the company. Exactly how we model that out in the 3-year plans over the next few years, we need to see how we tackle that in the second half. There was a question at the very back.
Good morning. It's Richard Major from Macquarie speaking here. 3 questions. Well, first, long term, the e-commerce portfolio. I mean, MTN has previously communicated this Amazon of Africa vision, and we have another half of losses. Is there a horizon to, say, an EBITDA or net income break even on that portfolio? Second question. MTN's previous guidance was Nigeria EBITDA is 2% per 10% weakening of the Naira. The Naira's collapsed 15% this week. Is that still the guidance? And then the third question. Last year in Iran, the regulator dropped the transmission pricing, and you spoke about 100+% data traffic growth. Is it likely that there'll be another step down in transmission pricing in Iran this year? Thank you.
Sure. Okay, so the question number around the e-commerce portfolio. I think if I could just put it at a high-level perspective, basically in that digital service world, we think that there are 4 key verticals. So the first vertical is mobile financial services. That's the mobile money we discussed already. There's entertainment, where you see the streaming, video, mobile video, etc. There's lifestyle, where you see all of the ringback tones and education, a whole bunch of things. And the final one is e-commerce. Now, the e-commerce is a very fragmented space. And I think our strategy historically, and our strategy still today, is that we participate in the 4th vertical via the 3 Rocket JVs. And I think this is a good positioning for us. We get a big exposure to the vertical without ourselves trying to start, the next Uber of Africa or the Foodora of a particular market. And I think in general we're pretty encouraged by the progress. There's some challenges here and there, but in general, if you look at in the Iranian market, IAG doing really well. If you look at Snap in particular, Middle East and Africa as well. There's as much good as bad. It's a kind of accelerator kind of strategy. You're not going to get 10 out of 10 winners. And we do think that the cash calls from the JVs are going to come down over time. That's what's in our business plans. You already saw the losses coming down in the associate structure. So I think that is, pretty much all in track. I think your final question around the transmission in the Iranian market, I think the important thing to know there is that we can self-provide the access transmission. We just can't self-provide the long-haul transmission, so the transmission between cities and geographies. There we have to buy from the incumbent operator. They have their own financial pressures. I was up there a week, 10 days or so ago, and I don't think we should be holding, any great hopes that there's a big price decline coming in long-haul transmission. Of course, we keep lobbying for it and arguing, etc. But the thing always to remember with the Arancel operation is that there's a very high revenue share in that license to government. So when we look at the margin a bit under pressure, 36, 37, with a 28% revenue share, this is still a very high margin business. And I think the team are doing pretty well there to try and balance all of these things out. I think we have time for 2 more questions.
Rob, sorry, there's just to clarify on the Naira rate that's been quoted on Bloomberg. The Nigerian government and the central bank they want to improve the disclosure. So they actually asked Bloomberg to start quoting the secondary rates. The actual official CBN rate remains 305 and the interbank rate remains 325. So the Naira hasn't actually moved. It's just on Bloomberg, the rate that you look there is actually a different rate from what they used to disclose. So there hasn't actually been any change.
Thanks, Nick. Nick, do you have any questions coming through on the webcast?
No, nothing material.
Okay, is there a last question from colleagues in the room? Mike, yes. Oh, and also, you have the mic.
I've got a mic.
Well, it is not Mike has the mic, and Mike needs a mic. Okay.
It's Chris Grumberg from UBS. I've only got 2 questions actually, so that's good. They're both on clarifications. Just to be clear on your Nigerian guidance, you're still looking for high single-digit growth for the year. You've obviously done north of that in the first half. I just want you to maybe explain if there's anything you're seeing in the second half that specifically justifies the deceleration. I would have thought potentially, given the maybe lower competition post the Etisalat news, that maybe you would have been more encouraged. So just like to get your thoughts on that. And then ditto on the CapEx guidance, and conscious of your comments around wanting to lead on technology. Appreciate the longer term, but how much of your change in CapEx guidance is about doing more, i.e. being more efficient with that CapEx, versus just currency constraints? Thanks.
Thanks, Chris. Yeah, so I think 2 things. On the very specific financial guidance, which is basically these 3 things of the revenue growth, SA, Nigeria, and the margin, we're not restating that guidance. We're just saying, we're on track. And if we were not on track, we would say so. So clearly, if you grow 10.8 in H1, you'd like to maintain that kind of trajectory in the second half. And that's certainly what we'll be pushing. Ferdy's sitting in the front row. He's looking a bit worried for what I promise on his behalf. But no, we're saying we will meet the guidance, and obviously we'd like to where possible, exceed it. And we're not expecting a big slowdown in H2. So I think that's how we would feel about that. I think on the CapEx, in some of the countries, we've actually, in a way, accelerated the CapEx. So you take South Africa example. The strong rand is giving us more CapEx for the original CapEx envelope of 11.5, and we've left the 11.5 in the guidance. So we thought rather let's take advantage of that and keep pushing the infrastructure out. Pretty much across the rest of the markets, we've encouraged them to still try and target their original rollout. So it's more they're just signaling that, they started a few months late. They're going to struggle to get it all in the ground. We've put a bit more CapEx into Ghana. Arancel obviously is putting quite some CapEx in there. I think it's really Nigeria is the one that is struggling to get through the numbers. That's not any great sort of incentive to slow down the investment profile. Did I miss a question? No. No. Cool. You have the last word, Michael.
Thanks, Rob. It's Mike Gresty from City. I'll hopefully try and make it count then if I'm having the last word. I just wanted to ask about Turkcell, actually. Obviously, that reared its ugly head again. Any thoughts relative to sort of the previous views on that and possibly around timelines when that might be finalized, if you've got any ideas on that?
Yeah, so I think, you know, for those that follow the stock, for many years now, the unsuccessful bidder for the license in the Ransel has been contending that there were irregularities on behalf of MTN. We don't agree with that at all. We think they're completely spurious. I've studied the matter in depth myself. The Hoffman report, which was built basically to help all of us understand what happened, is publicly available. Anybody who's concerned about the matter, you know, read the report. It's 280 pages, or you can read the first 18 pages. And, you know, I think this is a spurious allegation, and we will not be bullied. We will defend ourselves very vigorously. But, you know, it will take time. The legal process will take time, and it's one of these sort of stories that's going to unfold slowly. But, you know, I'm entirely comfortable with MTN's position on Turkcell. So with that, on that inspiring note, hate to finish with a turkey. I'd like to thank you all for your attendance, for coming out here this morning to listen to our story. I think we have a great company. We're obviously working very hard to make it better. We appreciate your support, and please join us outside for some refreshments. Thanks.